Hola amigos and amigas. Today in this video we are going to be talking about how to invest in 2021. During these unprecedented times when we're seeing more and more people, mainly on the younger millennial side, taking an interest in investing. Maybe they lost their job, maybe they want to create a second source of income. There's tons of reasons why someone might want to invest in this day and age. And although they might want to, the problem is they don't know how. They don't know what a stock is, they don't know how to buy a stock, they don't know the difference between an individual stock and an index fund. And we're going to talk about all of this in this video today. This is going to be a very value-packed video. It's probably going to be the most value-packed video I've ever made on YouTube. Actually, it might even be the longest video I've ever made on YouTube. Like I just said, investing is important for so many reasons, and people know in this day and age if they ever want to retire, they have to start investing. But again, they just don't know how, and that's what I really want to attack in this video, and I really just want to bring a ton of value to all those new investors out there in the year 2021. I actually recommend you take out a pen and a piece of paper and you actually write down a lot of the stuff we talk about in this video. That way you can continue to do Google searches, YouTube searches, and just do more research on your own to get a better understanding of these investing topics we're going to talk about. Like I just said, this video is going to provide a lot of value, and it did take me a long time to make. It actually took me a couple of weeks to make this video. So if you guys don't mind hitting that thumbs up button, that really helps me out in a huge way, and I appreciate every single one of you that do that. And as always, don't forget to subscribe to the channel as well for everything stock market related news, personal finance, and everything in between. First things first, regardless of what we talk about in this video, make sure you are doing your own research and your own due diligence, and you are developing your own opinions. Secondly, this video is going to be based more so around long-term modern investing. We're not really going to focus on too much of the technical analysis here, but more of the fundamentals. I have a couple of friends that are into really technical analysis and day trading, but that's just not for me. I don't really believe in it. I don't think it's necessary personally to be a successful investor and grow wealth. If you're unfamiliar with what technical analysis is, it's basically looking at stock charts and trying to find different patterns and execute those patterns before the stock ends up breaking out. If you look at anything on CNBC, you'll see them talking about XYZ stock and you'll see a chart on there. Basically, technical analysis is breaking down that chart and just finding good entry and exit points and getting in and out very quickly. Like I just said, I truly don't believe technical analysis is necessary to be a successful investor. I really don't think Warren Buffett looks at too many charts in this day and age. Actually, if he's never looked at a stock chart and done any sort of technical analysis in his entire life, that really would not surprise me in the least. But again, just to reiterate, we are going to focus on more modern, long-term fundamental investing in this video. We're not really going to focus on what's happening today in the markets, tomorrow in the markets, next week in the markets, next month in the markets, but over a period of years. So before we get into really anything in depth in this video of how to pick stocks and what to look for in a stock, we have to talk about the basics, and that includes what is a stock. We aren't going to go too in depth on this topic, but we do need to cover it because if you're someone watching this video and you've never invested a single penny in your life, you might not even understand the stock market and what a stock is. So basically, a stock is a piece of a company. That's the simplest way you can put it. So when you watching this video, when you buy your first stock, you are essentially buying a piece of a company and you are part owner of that company. So say for example, if you buy one share of Apple stock at $120, you are part owner of Apple stock, and that's actually awesome. And it's important to think of it this way when you actually buy a stock, that you're part owner of that company, because if you have that mindset, you're gonna think, well, what direction do I want this company to go in? What do I want this company to do in revenues and sales next year over the course of 5 years? And just having that mindset, it's gonna allow you to just be more business minded, and you're really gonna see a better direction, and you're gonna be able to think more clearly is the bottom line. You can also think of things like, okay, this company just hired this CEO, this company just brought this person onto this management team. How do I feel about them, and do I like it? Granted, you aren't going to have a direct impact because you're not interviewing any of these people, but at the same time, it's very important to have that mindset, and that's what it's like investing in the stock market. It's all about mindset and knowing your strategies. Now that we know what a stock is, the second thing we're going to talk about in this video is how can you actually buy a stock? Unless you are someone who basically your parents put some money away for you, invested in the stock market, which I'm sure a lot of you watching this video aren't that lucky. The point is, you don't own stocks. You don't own anything. You have to go and buy them yourself. So needless to say, before you actually invest in the stock market, you need to know how to buy stocks, right? It's not as complicated to do this as it was 40 or 50 years ago. Now you can literally just go into the App Store on your phone and type in investing apps, and a bunch will come up. So let's do that right now. We'll go to App Store and we'll type in investing apps. And as you see, we have a bunch that come up here. We have Fidelity, we have Robinhood, we have Acorns, Stash, Fidelity again, Schwab, E-Trade. There's tons and tons of apps that you can just download literally at your fingertips to start investing today. I personally use both Vanguard and Fidelity, but you can use tons of platforms like Webull, Robinhood, M1 Finance. There's tons and tons. And actually, so years ago, it wasn't even that many years ago, it was maybe like 2 or 3 years ago, a lot of these platforms you had to pay commissions on. So say you bought one share of Apple stock at $120, you would have to pay It would be depending on the platform, but you would have to pay, say, $5, $10, $20 per trade. So say you were buying one share at a time, you'd have to pay, say, $5 for every share you bought. And it'd be that way for regardless of what your market purchase would be. So if you bought, say, 10 shares, you would still have to pay that just $5 fee. But what Robinhood came in, Robinhood was the first platform to really offer commission-free trades. And once they did that, all the other brokerages started to come down. They cut them, and now almost every single platform is at $0. They're all commission-free. So there's really no real reason to be paying any sort of commission per trade in 2020. Another thing you can do with all these platforms, or almost all these platforms, is buy fractional shares. I know you can do this with Fidelity and M1 Finance, but I'm pretty sure almost every single platform you can do this with. So basically what fractional shares are is, say you want to buy a share of Amazon, but you don't have $3,000 to invest, you only have $1,500 and you want to put it all into Amazon. What you can do is you can buy half a share of Amazon. So every time Amazon goes up $1, you'll receive a 50-cent return on that dollar. This is really good for people just starting to invest that don't have a ton of money and they just want to start putting little bits of money into the market, so that way they can still see returns and they can get a feel for the markets, how they work. So now we know what a stock is, we know how to buy a stock, but now we need to pick our investing strategy. And there's two main fields of investing strategies we're going to talk about in this video, being passive and active investing. So let's start with active investing. So when I talk about on this channel, say a stock analysis video, some sort of stock news, any sort of stock research, that's active investing because it's exactly what it sounds like. It's active. I'm continuously researching companies and researching stocks to buy into. If you want to take an active investing strategy, basically what you have to do is you have to log on to your computer and you have to look up different stocks and you have to research different companies and the companies you own a couple of times a week. I would say no less than once a week, but you have to stay up to date with them. And honestly, a lot of new investors are going to have problems with this, mainly because they're not used to putting in all this work, and it is a lot of work, guys. Active investing is not easy. A lot of people do it because you can see greater returns, but I don't know if I would recommend it to a new investor. But there are different strategies that you can utilize in the field of active investing, and one of them is value investing. So for example, say like back in March and April when stocks like Walmart might have been a little beaten down, that would be an example of investing at value because the stock is a blue chip company that's gotten really through recessions before and it's just undervalued compared to its current price. When doing this, you're going to want to pay a little bit more attention to things like the PE ratio, price to book ratio, price to sales ratio, and we're going to talk about those things in a minute, but all these things can be found under the statistics tab on Yahoo Finance. Another strategy that you can use inside of active investing is growth investing. This is something that I personally think you need to be a little bit more of a seasoned investor to do. I definitely would not recommend this to beginners, but hey, again, I'm not a financial advisor, so you can make your own decisions and you got to do what's best for you. But basically, growth investing is looking at a company that has strong potential upside. It might not be the strongest company at the time. It might have a very smaller market cap. Maybe it's very undervalued. But after you look at the business model and the management team, you look at the industry that this company is in, you think that this company is poised to do well in the future and continue to grow, and you really just think Wall Street is sleeping on this stock and has not priced it correctly. A lot of times in growth investing, you want to focus on industries that are up and coming. Like for example, when I bought Skyworks Solutions at about $75 or whatever I had it at, I was looking at more of the 5G industry that I felt had strong upside and potential, and ultimately I felt Skyworks really fit that criteria for me personally. You could also say the same exact thing with Tesla. The world is moving towards more and more electric cars, and Tesla was really the main player in that industry, and they didn't have a ton of competition, and there was really no one that's going to challenge them in that field, in my personal opinion at least. Obviously, Tesla's not really looked as a growth stock anymore. It's looked at more of a beast, but at a certain time, 2 or 3 years ago, it was definitely more of a growth stock. Another strategy that you can use in active investing is momentum investing, and I really would not recommend this. I feel like this one's a little bit more dangerous, especially to new investors, but it does work for some people. Basically, to summarize, people use this strategy and they think that winners are going to keep winning and losers are going to keep losing. In other words, you want to look at stocks that you think are going to continue to rise. So maybe stocks are up 5 or 10% over the past couple of months, some stock you're looking at, and you decide you want to buy into that because you think it's going to keep going up. On the opposite side, you want to stay away from losing stocks that are maybe down 5 or 10% over the past couple of months because you think they're going to keep falling and you don't want to catch the falling knife. This strategy is more so used people that are into technical analysis and day trading, but you can also use it for long-term investing if you really do believe in it. I personally don't like this strategy because when stocks do go down, sometimes they are really great deals, but ultimately you got to make the decision whatever strategy works for you if you want to take this approach of active investing. So now let's move on to passive investing, which a lot more people who are watching this video might be more fond of. So unlike active investing, passive investing is basically investing your money into some sort of fund or some sort of investment, and you basically just forget it's even there. Passive investing methods seek to avoid the fees and limited performance that may occur with frequent trading. Passive investing's goal is to build wealth gradually. Also known as a buy and hold strategy, passive investing means buying a security to own it long term. Unlike active traders, passive investors do not seek to profit from short-term price fluctuations or market timing. The underlying assumption of passive investment strategy is that the market posts positive returns over time. The main passive investing strategy I personally like to use, and I do use this myself, is just buying and holding some sort of index or ETF that tracks the S&P 500. By using this simple strategy, you're much more likely to see a return each year that is between 8 and 10%. And if you aren't sure what a fund is that tracks the S&P 500 and why it historically receives 8 to 10%, basically think of it this way. When you go out for pizza, you can get any sort of pizza you want. You can get cheese, pepperoni, buffalo chicken, barbecue, but let's say you want all of those pizzas. That's basically what the S&P 500 is, all of those pizzas into one. So if you want to buy Apple, Amazon, Facebook, but you can only afford, say, one of them, you can get all of them in the S&P 500. You can get a piece of Apple, you can get a piece of Amazon, you can get a piece of this stock. You get little bits and pieces of it, and you have a very well diversified portfolio. This strategy is honestly great for anyone that wants to get into investing and they don't really want to worry about it, they don't want to think about it too much, and they just want to take a little bit of their money out of their check and invest it into some sort of fund and see returns. So now we've talked about what a stock is, how we can buy a stock, different investing strategies. We've picked our investing strategy, but now we don't know how long to hold these funds for. First off, the amount of time you hold an investment for is honestly going to be up to you, and it's really ultimately going to depend on your investing strategy. Say you're looking more into active investing strategies, that's going to depend more on how you value those companies. You're going to have to run a lot of numbers. You're going to have to really decide for yourself if that stock's overvalued, undervalued, where that fair valuation is, and ultimately pick a good time to sell out based on your own opinions and calculations. However, in my opinion, if you are going to take more of a passive investing strategy and buy some sort of index and ETF that tracks the S&P 500, ultimately, unless you need the money to put into another sort of investment, or maybe you have some sort of emergency that came up, I really truly think you're better on just holding these investments forever. But ultimately, for active and passive investing strategies, you really want to look at the long term. You don't want to focus on what's happening today, tomorrow, next week, next month, but over the course of a period of years. I don't care what anyone tells you, I really don't. I don't care if it's me, I don't care if it's Warren Buffett, I don't care if it's financial education, I don't care if it's Graham Stephan. No one, and I mean no one, knows where the market is going in the short term. If anyone knew where the market was going in the short term, don't you think that we would be back towards the lower end of where the Dow was in March and April as opposed to near all-time highs? I think that would make a lot of sense in my personal opinion. But one thing we do know, if we look at the data, the stock market is going to continue to rise. Every 3 out of 4 years, the stock market usually rises, which means about 70% of the time, your investment has a chance to go up each year. So if you buy into a stock or some sort of fund and it dips and you truly believe in that investment, don't panic sell, just hold for the long term. Just say to yourself if that happens, okay, so this stock is here right now, I'm down this much, but where do I see this going over the course of 5 to 10 years? If you bought into SPY, which is an ETF that tracks the S&P 500, if you bought into that at all-time highs in 2008, watch the market crash due to the recession, but held during that time, you would still be up massively, 12 years later. Absolutely massively. This just proves that if you are going to make some sort of investment, especially in the stock market, long-term is the best way to go, at least in my personal opinion. So let's take more of a step back towards individual stocks here. You like the passive investing strategy, but you also want to do a little bit of active investing. You want to pick some individual companies. And to do that, there's a lot of research that you have to do and a lot of different types of research. You've got to do some qualitative and some quantitative research. Quantitative research is more so looking into the financials of the company, looking at the numbers quarter over quarter and year over year, and ultimately seeing if the company is progressing over time. But there's also qualitative research, which I think a lot of people actually skip over when investing in individual companies, which I would not recommend by any means. This is basically looking at the CEO, the business model, and just looking at the basic fundamentals of the company and making a decision of where you think that company's going to go over time based on what you see there. This is important because ultimately the business model and the CEO are both going to make the company, especially the CEO. A CEO can take a really bad beaten down company and he can change it around completely with different visions and different philosophies. Where do you think Apple would be today without Steve Jobs? Where do you think Tesla would be today without Elon Musk? It's very debatable that they would not be as successful as they are today without those guys in their positions. Bottom line, do not sleep on the qualitative research. Do not by any means. Now that we've talked about those two types of research, we have to look at the question, where do we do our research? You can do this research by simply Googling the company's investor relations page. So let's say you want to invest in Apple. You can go to Google and simply type in Apple investor relations. You can go and get all the information you need to get on the company. In my opinion, when you first start investing in individual companies, the first thing you need to read about that company is the 10K, which is the annual report for that company. I read this first because I want to know how the company looks from more of a long-term perspective before I get into any sort of recent news and how the company looks quarter over quarter. And side note, when I say year over year, that's mainly referring to how the company has done over the past year. So say the company grew 10% in revenue in the third quarter of 2020, year over year. That means revenue has increased 10% in the third quarter of 2020 compared to 2019. And if I say quarter over quarter, it's just referring to the quarter over quarter comparison. So if I say a company grew 20% in the third quarter of 2020, quarter over quarter, that means they grew 20% from the third quarter of 2020 compared to the second quarter. After you read the 10K, you're going to want to start reading the 10Q, which is more recent news, and it's going to have to do with how the company did in the previous quarter, which is the course of 3 months. And these documents can actually be really long. Sometimes these reports are over 100 pages. Sometimes they can even be 300 pages. One of my friends brought one to my attention the other day. It was 500 pages. So you have to ask yourself, are you willing to put in this work regarding to investing in individual companies, or do you want to take a more passive investing strategy? Once you read the 10K, you're going to want to perform a little more of Google searches on the company. So you can Google something like Apple stock news, and you can find all the recent news within that company, what is going on, who is doing what, everything in between. You can find out what the company's doing, any news on the company, what's going on, who's doing what, etc., etc. After you do that, you're also going to want to do some research on the CEO. You want to look at things, where was the company 5 years ago when the CEO took over? What is some adversity that the CEO went through and brought this company through and took them out of? What is his or her background? What was his or her upbringing? All of these questions are things that you're going to want to be asking yourself before you ultimately buy into this company. Then you're going to want to listen to the conference call, which is the CEO talking about the most recent quarter, and you're going to review any investor presentations that are on that investor presentations page. And then another thing you're going to want to do, and we can't talk about all of these, but we are going to talk about a couple of them, is looking at the metrics of the company, which we'll kind of touch upon here, but like I just said, we can't talk about all of them, but they are available on Yahoo Finance if you want to check them out. The first one is the PE ratio, or the price to earnings ratio. This is exactly what it sounds like. It's the company's stock price in relation to its earnings. This is important because a higher PE ratio might mean the company's overvalued, but too low of PE ratio might mean the company's just really not profitable and might not be a good investment for you. There's also trailing PEs and forward PEs. A trailing PE is what the company's done over the past 12 months, while a forward PE is what the company's going to do over the next 12 months. There's also the price to sales ratio, and this is calculated by really just taking the market cap of the company, which if you don't know what that is, basically the market cap is the valuation of the company and how much the company is ultimately worth. So you take the market cap of the company and you'll divide it by the revenue of that company has earned over the past 12 months. And like I said before, there are several other metrics that I look into, but we are just going to talk about one more here for the sake of time, and that's the price to book ratio. This is ultimately calculated by dividing the stock price of the company by the book value per share. And the reason that's the last one we're going to talk about is because there has been a lot we've talked about in this video so far, and I'm sure that if you are a really new investor, a lot of this might be a little over your head and you're already going to have to do a lot more research. So we don't want to completely overwhelm you in this video. And you might be thinking to yourself, this seems like a lot of work, and that's the truth. Investing in individual stocks is not easy. It's not supposed to be easy to pick individual stocks and outperform the market. That's why Warren Buffett recommends that you just put your money in some sort of fund that tracks the S&P 500. But if you are willing to read the 10Ks, read the 10Qs, listen to the conference calls, look at the investor presentation, everything we just talked about, look at the metrics, then you can see a 15 to 20% return per year, and it's ultimately going to be worth it for you. But if you don't want to do that, if you don't want to waste hours and hours and hours reading about different stocks, then just put your money in some sort of index fund, in my personal opinion, and you'll still see pretty good returns. And you actually want to make sure you're reading these reports. You don't just want to invest blindly, because if you are reading these reports, but you're just kind of like skimming them, the company is ultimately going to make it look like more of a positive outlook because the company does write these reports. So you need to more or less read them very carefully and read between the lines so you can decide if this is a good investment, if you decide to go with the active investing approach. And the last thing we're going to talk about in this video before we kind of get into the conclusion and final thoughts is risk tolerance. So what do I mean by risk tolerance? It's going to depend on how much you can tolerate your money going up and down. So for example, say you have $12,000 to your name and you decide that you want to invest $10,000 of that $12,000. Well, if you see your portfolio going up and down and up and down, God forbid it's something like in March where the thing just tanks, you might not be able to handle it. You might not be able to sleep at night. You might be mean to your loved ones, your family, your friends, and that's not a place you want to be in, guys. That is not good. I would not recommend anyone getting into that place. So say instead of investing that $10,000, you invest $200 out of that $12,000. Well, you're going to be able to tolerate that risk a little bit more because it's not as much of your money, especially when you're first getting into investing. And then over time, you can take a little bit more out of your check and continue to invest it and build that risk tolerance over time. So eventually when you do have $10,000, $20,000, $100,000 invested in the stock market, you're not really going to blink when it goes up and down and up and down. You're going to sleep perfectly fine at night, and you're going to know over the long term that you are going to make money. You're going to turn that money into money, and you will be able to retire early and achieve financial freedom ultimately. And some of you might be thinking, well, $200 is not going to make me any sort of money, but what if you invest $200 every month or $200 every week? Eventually, over time, that's going to grow. You'll eventually turn into 4-figure positions, 5-figure positions, 6-figure positions. And for some of you guys that really take it seriously, and I really hope some of you guys who are watching this video get some value out of it, you're going to be able to turn those portfolios into 7-figure positions. I truly believe that everyone watching this video can do that. It's just up to you to start, guys. You really just got to start. That's the first step in anything successful. Jeff Bezos would have never created Amazon if he never started. Tesla would not be a thing if Elon Musk did not start. Apple, who knows where it would be if Steve Jobs never started. That's the key, guys. You just have to start. And the bottom line to start to wrap up this video here is you might be a little confused when watching this video, and you might think, well, investing's just not for me. Stop right there. That is not the case. If you're a little confused, that's completely fine. There's a lot we talk about in this video. I can completely understand why some of it might have been way over your head. My goal in this video was kind of to show you the water, and it's up to you to decide if you want to drink it or not. Although I really think it's a good idea to drink the water, start doing some research and start investing. Ultimately, that's going to be up to you watching this video. But here's what I want to ask you before we end this video. That's right, you. I'm talking to you watching this video. Do you want to work the rest of your life at that job you have right now? Do you want to be someone who's in their mid to late 60s and still paying a mortgage? Do you want to be someone that is working till they're 80 because they just can't afford to retire? Do you only want to have a couple of years to travel the world? Because if you decide that's not the situation, that's not the life that you want to live, I really hope you take these next steps to start investing today. Go ask your parents about the stock market. Give your significant other a phone call. Text one of your friends who you know that's interested in stock. Don't be afraid to take the first step towards financial freedom today. Guys, thank you so much for watching. If you made it to this point in the video, I really appreciate it. I really hope you guys got some value out of this video. Let me know in the comments if you got any value out of this video, if you plan on taking your steps towards investing today. Like and subscribe as always. And like I just said, I really hope that you take the first steps towards investing and changing your life. And I will see you guys in the next video.